Hello, and thank you for joining us. I'm Bill Dodson. I'm here with my colleague Dave Schlosser. We are both bankers with Stifel Financial in the religion finance practice, and we're here to be a part of the BGW Embedded Church Seminar Series, and we're very, very happy to be partnering with BGW on this effort. Today, we would like to share with you some important information about long-term financing options for churches. We think that this information will be enlightening, that it will help you make the best decision for your church when it comes to how you finance your project. We'll start by telling you a little bit about Stifel so you know who we are, and some of the work that we've done with ministries across the country, give you a couple of examples that you might identify with. We'll also introduce you to what long-term bond financing is, and talk a little bit about how it differs from traditional bank financing as well. And then, of course, a little bit about the process for how you get from application to closing. So I'm going to tell you a little bit about Stifel. Stifel was founded in 1890. It's an investment bank, so we're not a depository institution like the bank down the street where you might have your checking account. Our headquarters is in St. Louis, Missouri. We like to think that we're a Main Street firm, not a Wall Street firm, and our public finance, of which this religion finance practice is a part, probably does more work with local communities than any other investment bank in the country. We have about 7,000 employees, almost $3 billion worth of shareholder equity, and we manage over $220 billion of client assets. Importantly, we trade about $500 billion worth of bonds every year, so that gives you a little bit of an idea of our expertise and the scope of our capability. So Dave, I'm going to turn this over to you now and let you talk a little bit about some of the ministries that we've helped around the country in the last year or so.
Great, thanks, Bill. So as you're seeing on your screen here are some recent financings that we have underwritten across the country. Our minimum loan requirement is $1.5 million, and we will go up to $20 million. And as you can see, again, the number of projects that we've done vary from acquisition, renovation, refinancing, and new construction. And I want to highlight one specific project, which is Keystone Church on the far right down below. That was a $17 million financing that we did back in November of 19. We were really competing with two other lending institutions. One was a commercial lender. They were regulated and required to get an appraisal. When the as-built value came back, the value was not near and close to where the church needed the value to be able to fully fund its project. Required a lot more cash infusion for the church. So that's sometimes what happens when you go out and get an as-built appraisal. We had a competing bond firm on the transaction as well. They were what's called a best efforts firm, which means that they wanted to start the sale of bonds to members of the church. And this church had a very large capital campaign that they were involved in and did not want any sales to members of the church. So Stifel stepped in and with our what we call firm underwritten program, and a firm underwriting is defined as a contractual obligation on the behalf of Stifel to buy all of the bonds, whether we sell them or not. And we were able to get the transaction done in about a week and a half, the sales time. So on a $17 million deal, it was really a project that was well accepted by our investors, and the transaction was closed very successfully. So we'll talk a little bit more about the firm underwriting program of Stifel versus the best efforts program as we go through the presentation.
So what is bond financing? Bond financing is the issuance of debt obligations by the church. Essentially, the loan is cut up into pieces, and pieces of that loan are sold to investors. That's one way to think about it. The bonds are underwritten by Stifel and sold to the investing public. And what I mean by that, and what Dave was talking about earlier with the Keystone Project, is that a few days before closing, we're going to sign an agreement. And the agreement is going to say that Stifel will buy the bonds with its own capital from the church. So that means that you get 100% funding on the closing date, because we're putting our capital to work and then selling the bonds to investors at our risk. Usually those bonds are issued in a series of maturities, and the final maturity can range as high as 25 years. We've done 30 years in the past. 25 years is typical, I would say. As with most church financing debt you would expect, it's going to be secured by a first mortgage or a deed of trust, depending on the state you live in. So it'll be secured by the real property of the church. Very important, the bonds are serviced by an independent third-party trustee. So it's not Stifel, and the church doesn't have to, in fact, the church won't know who the bondholders are and won't have any direct contact with those bondholders. That's all done by a third-party trustee, takes all the administration off of the church's plate. So that's also a very, very important aspect of the financing relationship, is that servicing by a third-party trustee. So Dave, tell us a little bit about the difference between a traditional bank loan and bond financing. It's quite different, isn't it?
Yes, Bill, it is. And so on the traditional bank loan side, we have seen the typical deal be about 5 years. And that's a short-term maturity. With bond financing, we're looking at a long-term maturity. As I mentioned, will go up to 30 years fixed. Again, the most popular term is a 25-year fixed rate deal. With 5-year fixed rate money, or with 5-year money on the traditional bank side, it is a variable rate, which means you're going to have to adjust that rate at 5 years, which really exposes the church to interest rate risk should rates rise in that initial 5 years. Again, with the Stifel fixed rate program, you completely eliminate any interest rate risk. The traditional bank loan has a balloon payment, and there is exposure to what's called renewal risk. In my 34 years of underwriting churches, we've been through a number of recessions, and we are now going through a pandemic where I've seen banks go to the sideline during these kinds of times. And that leaves the church without the ability to refinance or renew the deal because they've lost a lender. With bond financing, there is no balloon payment. This is a fully amortized transaction, level debt service all the way through the deal. The traditional bank loan will have prepayment penalties, interest rate swaps, or yield maintenance provisions. Each one of those would require a penalty payment should you want to refinance out of the bank deal. On the bond financing side, there are no prepayment penalties, swaps, or yield maintenance provisions. The traditional bank loan is going to have ongoing financial performance covenants. Okay, the typical covenants that we see are what's called a debt service coverage ratio, which means the church must meet a minimum debt service coverage ratio each and every year, and a liquidity requirement. Again, whatever the bank typically sets up on the front end, the church needs to meet that, and that's tested every year once the church sends its financial statement to the bank. If you're not in compliance, this can result in a technical default of your loan. On our side of the bond financing, we have no ongoing financial performance covenants other than an annual audited statement. The bank loan is going to require a banking relationship. So not only will you have your mortgage through the bank, but you will have to do a banking relationship as well, where all your depository money will be sent. On our side of the fence, we do not have a required banking relationship, and churches like that because all we ask is you to send your monthly payment into a third-party bond trustee, which allows you then to keep your banking relationship locally. And on the bank loan side, the banks are typically and are regulated under what's called FIRREA, and they will require an appraisal. You heard me talk a little bit about the Keystone project, where when the bank went and got the appraisal, the as-built value did not meet the test or the value that the church needed to fully fund its project. On our side, we do not typically need an appraisal. We are not regulated under FIRREA. And in most cases, we'll take the net book value of the church's fixed assets. We'll add to that the cost of the project to come up with our pool of collateral. And typically from that pool, adequate financing will be available to fully fund the project.
So let's talk for a minute about what we call the 4 C's, which is to say the general credit guidelines that we use to determine whether a church qualifies, would make a good risk for our investors with bond financing. And the 4 C's are capacity, collateral, character, and competence. Capacity is simply a way of looking at the numbers. It's typically mostly derived from the financial statements. And we want to determine if the church actually can afford to service the amount of debt that they're asking for. So we'll look at a debt service coverage ratio, which is the margin that's the cash flow margin that's available to service debt. We'll look at debt service as a percentage of revenue. For example, we wouldn't want the church to spend more than 1/3 of its revenue on debt service. Long-term debt to revenue, so we wouldn't want a church to borrow more than 4 times its total revenue. And at the time of closing, we would like to see the church have about 60 days of cash on hand, so enough cash to pay the expenses of the church for 60 days as a minimum requirement. So having looked at those numbers to see if the church can actually afford the debt, then we move to looking at what kind of collateral we have. As Dave discussed, we don't always need an appraisal. There are some alternative ways of valuing the collateral. But in every case, we're going to need a minimum loan-to-value ratio of 75%. We do want some environmental assessment of the collateral of the property. That's done through what's called a phase 1 environmental assessment. Those are not expensive, they're easy to obtain. And then of course, depending on what the title company might want, there could need to have a survey, not always, but sometimes that's necessary. So if capacity and collateral all line up, then we can move on to looking at character. And this is very, very important. We want to know that the leadership team at the church can be, has integrity, that they can be seen as people who are not only able to make the payments, but willing to make the payments. And that's a very important consideration. So we're going to look at whether or not the governance structure of the church holds the right people accountable. So the relationship between the board of elders and the pastoral team, how they function, who has authority to do what. We'll look at a background check on the senior pastor, maybe 1 or 2 other senior team members if that seems necessary. We'll look to make sure that the church is not involved in any lawsuits. That's rare, but sometimes we find it. And then, of course, one of our best friends as underwriters is an internet search. You'd be surprised if 3 things line up. Then we move on to competence, look at the resumes of the senior leaders, check to see that administrative processes are adequate to the size and complexity of the ministry. What kind of accounting capability does the church have internally? And then, of course, some of the measures of effectiveness of a ministry might be historical growth trends in terms of attendance or membership, and historical evidence that the church can work its way through the problems of growth. That gives us a good sense of what the future of the church is going to be like. Should our investors decide to extend 25-year financing, they're going to want to know that there's a competent leadership team involved in leading the ministry. So that's not all the conditions that we'll look at as we'll underwrite. There's some little detail-y things that we'll get into, but that gives you a good sense of what we're looking for. So Dave, in terms of general terms and conditions of the financing, can you give us a sense of what that might look like?
Sure. So the instrument that we were going to issue will be what's called a first mortgage bond issue. So again, a first mortgage will be filed against the church's property. The interest type, as I mentioned, it is a fixed and long-term fixed rate. Final maturity, typically 15 to 25 years are more popular terms that churches choose, and we will go up to a 30-year fixed rate transaction. The amortization, this is a fully amortized level debt service transaction, which makes your budgeting much easier knowing that your payment will not change over the life of the loan. We do provide a 2-year interest-only period during construction, which really helps the church's cash flow during the period of construction. We have no prepayment penalties as disclosed and discussed before. The only thing we ask is a church needs to make a 30-day notice to the bond trustee so the trustee can notify those bondholders who will be paid out early. The security type is again, a first mortgage deed of trust filed against the church property, and we also file UCC financing statements against the church's equipment and furniture fixtures. We also require a key man insurance policy on the senior pastor. The amount of that is 1 year of debt service, and that insurance policy is collaterally assigned to the trustee. Our only, again, ongoing financial requirement is an annual audited report, which we like to see and required annually within 120 days of the year end. There is a continuing disclosure website that the bond trustee has where the audit report is posted. A compliance certification is filed. And then if there's any material event against the church, for instance, maybe the loss of a pastor, which is material to the operations, the church needs to disclose that to the bond trustee. And lastly, this is a fully underwritten 100% funding on closing date. We do not require any member sales. As I alluded to on the Keystone transaction, Stifel raised the full $17 million, although in that situation, not all the bonds were sold at the time of funding. However, Stifel did come up with the additional capital to fully fund the transaction at close. So those are some of the general terms and conditions that we put on our bond transactions.
Thank you, Dave. So the cycle time, in terms of how long does it take to get from application to closing, the cycle time depends largely on the readiness of the church. Before we can close, obviously, we have to have construction permits, financial statements. There are a lot of parties involved in a complex transaction like a construction project. And so all those things have to be ready before closing. But having said that, we can typically close within 35 to 40 days of receiving the audit report, provided that those construction permits and things are in place. So the process is this. We start with qualification. So we would collect from the church some financial statements, copy of the bylaws, history of the church, a list of the board of directors. We would analyze that information and get back to you with some sense of what might be possible in terms of financing. If you like that and you want to move forward to a formal proposal, then we'll put that together. Under normal conditions, we would come out and present that in person. It's still possible in some places, but don't be surprised if under current conditions we have to make this do with a Zoom call. Provided the board likes the proposal, then we would move on to engagement. And so we would sign an engagement letter, agree to work together on this transaction. We would begin pulling together the prospectus, all the information that's required for that. The church would get all those third-party reports like the audit and phase one, appraisal if it's required, those kinds of things. We pull all that together into a package for investors, markets the bonds to investors, and prepares to fund the transaction at closing. So there will be a marketing period that you can call an underwriting period, during which we will be making sure that the interest rate is right for the marketplace and that investors like what they see. And at the conclusion of that underwriting period, then we move to closing. And of course, we're going to commit our capital to that closing, make sure that 100% funding is available at the title company on the closing date, and then the church can start its project, which is what we know you want to do. And the whole reason why we would partner with you on this, obviously, is to see your project built and your ministry move forward. So, Dave, if you have any closing comments for us, I just want to say that we're extremely pleased to be working with BGW and with their clients, the ministries that we've served. Dave and I have both been doing this for decades, literally. We just think this is a fantastic opportunity to work with some of the best ministries in the country.
Bill, yeah, I just want to say also that I'm excited to partner with BGW and look forward to these upcoming seminars where we can meet with individual churches and share our story, because we think it's a great story, and would look forward to that opportunity to partner with churches looking for project financing. So thank you very much for your time.
Fantastic. Thank you, Dave. I'm going to put our contact information on the screen for a few seconds before we end the presentation. So copy that down and give us a call. We'd love to hear from you.